Is a recession on the horizon? Well, hey everyone, it's John Chapman, certified financial planner with WorthPoint Wealth Management, here to talk today about the possible risks of a recession and how long-term investors can be planning right now. A study done by the Conference Board, which is a nonprofit independent research group, shows that there could be a potential drop in GDP in the fourth quarter of 2022 and in the first quarter of 2023. So these two quarters back to back would signify a possible recession. So to dive into the definitions and the root causes of a recession could be defined as 6 months or 2 quarters of declining GDP. GDP simply comprises of consumer spending and government spending. So you can think of this as families collectively in the U.S. spending less in a 6-month period than they did in the previous 6 months. And why would they do that? Well, some of the root causes of a recession could be job loss, so higher unemployment, and higher prices. Looking at this chart here, we've definitely experienced higher prices, whether it's at the grocery store or at the gas pump. As you can see on the left side, CPI, or our inflation rate, is much higher than it has been in our recent past. But conversely, and oddly enough, as you can see on the right, the unemployment situation is still positive. There's a 3.6% unemployment rate. And by historical norms, that's pretty low. This chart here shows what past recessions have been like and what the unemployment rate has been during those times. So you can see the average unemployment during a recession has been up to 8.5%. That is so much higher than what the unemployment situation is now. That's not to suggest that we couldn't get there, which that would be an unfortunate circumstance. But the labor market right now is simply very strong. And so it's important to know that a recession is not necessarily guaranteed. But even if a recession did occur, not suggesting that it would, you can see there's still lots of opportunity for long-term investors to continue to build their wealth over time. This chart here shows about a 100-year time frame of the S&P 500. The horizontal gray bars shows past recessions. And something that I really want to make sure to highlight is the stock market, while it can be volatile and it can go down, it oftentimes starts to recover and go back up before the economic data looks better. So it's important to not base our investment decisions solely off one economic factor of looking at a recession. So how should investors be building their portfolio? Well, it's based on these 3 things. First, it's looking at your financial goals. Let's pretend that's reaching financial independence by the time you retire. So number 2, it's looking at your time horizon. Maybe you've got 5 years, 10 years, 15 years until you're hoping to retire. So 3, you can create a portfolio based off of these 2 factors and your risk tolerance and say, if I want to be financially independent in 5 to 10 years, I'm willing to take risks. Maybe you can have a mixture of stocks and bonds that's more growth oriented and stick to your plan that way and not be as distracted with the potential for economic changes. So now that we've talked about investment profile, so now that we've talked about investment strategy, let's switch gears and talk about the true risks, because of course a recession would have some risks associated to it. So for people that are still working, the biggest risk is going to be job loss. So some action items to consider right now would be maybe first, continue to bolster and save up an emergency fund just in case you were to lose your job. You could stay on top of your monthly budget and have active communication within your household. And last, you could proactively navigate your career path by talking to mentors both within your company or outside your company to understand what your career path could look like if it did lead to a possible job loss. Switching gears, for retirees, the real risks is for investment prices to decrease or home values and home equity to decrease. So the action item for retirees is just to stay vigilant and on top of your budget and stay on top of your cash flow and aim to keep your portfolio withdrawals below 4%. So to use an example, $1 million portfolio should yield approximately 4% for retirement income. That'd be $40,000 per year or $3,300 per month. In the end, looking ahead, it's important to again just remember that your investment strategy shouldn't be based just on one backwards looking economic data point like a recession, but instead based on your financial goals, your time horizon, and your risk tolerance. And for employees right now, the best thing to do is to bolster your savings and navigate your career path. And for retirees, aim to keep your portfolio withdrawals within a safe line. And if you feel uneasy, then I strongly encourage you to reach out to a fiduciary financial planner so you can strengthen your financial plan.